Today, folks, here we sit at the end of an era, something that started in 2020, the pandemic that led to an ungodly amount of money printing that inflated the entire market, that led through us one of the craziest economic cycles that I've experienced in my investing career, is finally at its head. And here we sit trying to analyze what's going to happen moving forward, as today the Federal Reserve finally announced the 0.5% interest rate cut. We're going to try and use some parallels because Canada has already started cutting interest rates. We're going to take a look at how the market responded, because this is one of the most exceptional things for dividend investors, and I think we're going to start to see that excelled growth. We're going to discuss that in this video as well. That's a conversation you'd appreciate as we review my portfolio. I want to show you guys my stocks, just kind of where they're sitting, because there's a lot of hype kind of building into some of the stocks that I got. We're going to go through all of that. So subscribe if you're on a path to financial independence, to perhaps one day retire early, and let me know what you think in that comment section below. I'd love to hear about what you're doing and how you're playing this, because one of the most interesting things to me is money market funds and what it's going to mean when these rates finally start dropping significantly. Obviously, we're only at the head of the drop. I mean, we're talking about 0.5. We got a long ways to go before we're going to see any major material impacts, but you're going to start seeing headlines like this. Now is your last chance to lock in a guaranteed 5% return before the rates cuts, because like in Canada, you can get GICs that lock in these high rates for typically anywhere from a 3 to 5 year period at the most. That's usually as far as they let you go with decently high rates. But yeah, so money market funds here and these people that were locking in all this super high capital, which is sitting at 6.5 trillion in the US. What is going to happen? Are we going to continue to see all-time highs into Q3 and Q4 of the year, or is this going to start to level off and we're going to actually start seeing some of this money rotate into the market, which I'm speculating we've already begun to see, right? So the Fed dropped this, which was the summary and the projections, which we're going to hear about. The Fed is going to be a defining factor too on where the market goes, on how bullish or bearish they come off, or dovish, I guess is the terms. But yeah, if you're really bored and you want to read through the analytics, you absolutely can, but I'm still very confident that we're on the path to a soft landing. Everything is remaining a hell of a lot stronger than it should be for where we currently sit. And I remember how negative people were, saying that the market is going to crash when they start cutting interest rates. Every interest rate cut, there's a crash, because that's what's happened historically in the past, right? We haven't seen such a slow incline of an immediate interest rate raise followed by, usually the inevitable is a very dramatic cut, because then you get something like 2008 or the dot-com bubble, whatever. But we're not seeing that, right? We're seeing a relatively strong economy. And as the stock market, took a massive upswing on that news, and we're still seeing some fluttering, some profit taking as people are trying to digest this and figure out what it really means. But as I speculated, this is very, very good for dividend stocks. And what we saw at exactly 2 o'clock, look at the spike across the board. Primarily, obviously, my 3x leverage real estate ETF went from dramatically green. I think it jumped immediately 2.5 percentage points to actually going red to now being green again. We saw a massive spike up in the Schwab dividend equity ETF hit an all-time high of $85.04, over 1%. The S&P 500 has only really been up 0.6%, really showing that the market is paying a lot of attention to interest rate sensitive industries, which is what I told you guys to be paying attention to, because what we've seen in Canada as they've cut the rates, especially when you pay attention to the real estate ETFs like VRE, for example, this is why I'm saying, I'm just playing this slow. I'm not looking to sell off my triple leverage ETF yet, because I'm triple leveraging the US real estate market. And, when I look at what's happened in Canada since we've been slowly cutting rates, we get a little bit of fluttering, a little bit of profit taking, but there's this inevitable continual rise. And this is what I think we're going to see in the US. Because yeah, some people jump the gun early like me that want to get into this and try and trade it to the upside, but we have to keep imagining that over a year or two, this is going to have significant impacts on cash flows. And we're not going to see it right away, but the market's going to start pricing it in right away, which means we're going to see some big upswings, some profit taking, but I think it's going to be a continual upper trend, because many of these stocks have been largely suppressed for a very long time, and it has given them a lot of time to adjust to the higher interest rate environment. And a lot of them have survived, and some of them have flourished, but their stock prices haven't reflected it because of the perception of the interest rates. And here we are, folks. So if we take a look at my portfolio, primarily, I've been looking at the interest rate sensitive stocks. It's where I've been putting a lot of my money as of recent. It's why I really loaded up on VDY, the dividend oriented stocks that might not be as necessarily interest rate sensitive, but they'll be the stocks people are going to look at when they're no longer getting sufficient funds off GICs and bonds and treasuries, right? So VDY, I'm blown away because I took a massive amount of profit off Tesla. I think I made 10 Gs or whatever it was. I pivoted most of the position into VDY, which we're now up 7% on since I significantly added to the position. So we're crushing there. My DRM, my triple leveraged ETF is up 4 percentage points. I'm like I said, we'll play this one slow, see where it goes. I plan on holding it up to a year max, but if things really take a massive swing to the upside, we'll see where I end up because it's more of a short-term play for me. XLU has been doing pretty good, but not as well today, which was a bit of a surprise to me because when everything else shot up, we can actually see XLU is the only red stock I have today, which is quite surprising. But again, when it's gone on this historic run, where over the last 6 months it's up 25%, which is insane for a broad-based utility ETF. That really doesn't come as any surprise. I mean, it probably had the best run of the bunch here for the most part. But yeah, even still, the S&P 500 has been struggling, and it really goes to show you that in this market environment, it's been struggling to hit all-time highs, and I still think this is because of the valuation of tech. We're flirting with it, and this is going to be the first year we ever break trend, right? And I told you guys, usually for the last several years, we get a historic sell-off in September with a bottoming in October, followed by new highs coming into kind of the Santa rallies. And it looks like, this could be, I don't know if it's what they would refer to as a double top in technicals, but we are flirting with all-time highs in September, which is peculiar here. And it looks like today did we tap all-time highs right now? Let me zoom in on the 6 month here. It looks like we actually tapped all-time highs. Look at that. We're up 0.22%, up just a little bit from where we were coming into September from July. And wow, just wow. I mean, what a year. What a year, right? This is just absolutely astounding. You just can't get over it. Almost a 20% return on the S&P this year. It's just not jumping up as much. It's like we've been kind of stuck in this little trend area. But if it keeps going up now, we're at an all-time high, baby. Ain't nobody complaining here. But yeah, I think we're really just seeing the turnaround, though, in the stocks that need to catch up now. And it's the lower half of the market outside of tech that's really being resilient. But we are seeing a bump in tech right now, too. And tech should do better in a lower interest rate environment because if people find an ad spend that's working for them, they're going to double down, use line of credits and stuff, to go spend on Google ads, Facebook ads, a new iPhone, marketing material. All that stuff is going to come into play here very, very soon. I'm very happy with where SCHD is performing. As I showed you guys, we're up 13% in my RSP now in this account. It feels like it can't lose in this market environment. And I know we're all kind of gloating all-time highs, and I'm very glad I didn't get kind of suckered into and there's nothing wrong with having cash and GICs, but a lot of people went way too heavy into the 5% returners, really not paying attention to things like SHD, which I have been getting a much better return from now. That we're seeing a return in these dividend-oriented stocks. So the portfolio as a whole, my plan is to continue to sit tight with what I've got here. My end game is to eventually probably sell, obviously, my 3x leverage real estate ETF, depending on how it performs. I'm probably going to keep it for the rest of this year and just pan out the next interest rate cuts because we're going to see continual ones, and that should bake in hopefully more performance into the real estate sector. And I'm going to pivot that probably into VDY, and the S&P 500. And yeah, I'm just going to pay attention here. I'll keep an eye on XLU. I still like that ETF a lot. I'm not buying a whole lot of it here, but I'm using it also as kind of an interest rate recovery play. So we'll see how that pans out. I know it's up a lot this year, but we'll keep an eye on it. And yeah, it's just going to be really fun to see what happens next year, folks. But we're at the end of this era. A lot has led up to this point. Jerome Powell's become one of the most famous Federal Reserve, speakers next to probably Ben Bernanke. There's been a few of them, right? But wow, I'm so floored. It's been like a long time coming, and here we are. What do you think, man? I'd love to know what you guys are doing in that comment section below.